Hello and welcome to this Abn Amro Commercial Finance panel discussion, Flexible Finance for an Uncertain World. My name is Richard Young, and over the next 40 minutes or so, it's my great pleasure to steer a discussion on what's been a tumultuous year for British business. And we're going to be looking at some perspectives for how management teams can cope better with uncertainties in the year ahead. Joining me to cover these critical issues for most businesses are Jeremy Harrison, who's the head of sales for ABN AMRO Commercial Finance in the UK, Ross McDonald, who's head of debt advisory at accountancy firm BDO, and Gareth Stenger, Group Operations Director at Recruitment Investments. Gareth, I want to turn to you first. As someone who's running a business, who's experienced the highs and lows of 2020 from the front line, so to speak. Tell us a little bit about what that's been like for you and some of the ways in which your own business has had to become more agile and flexible over the course of this year.
There's the strategic element and the operational element. From a strategic point of view, we sat down as a board, a group of investors, and indeed discussions with ABN AMRO, during the early parts of the year as COVID kicked in during March and what have you, and we could see the direction of travel. And we all made a joint decision that strategically we were going to carry on being acquisitory even during that period. We were, in fact, at the point of lockdown in discussion with 3 companies. We'd already bought 3. We carried on with all of those 3 negotiations. Obviously, we were taking more of a risk, buying a business at such an uncertain time, and in some cases, buying businesses where we couldn't even attend the offices of the businesses we just bought. So there was a big risk on our part. However, to slightly amend the Warren Buffett quote, we decided we were going to be bold where others were fearful. And somewhere down the line, we'll probably be somewhat more fearful where others are being bold because they're so buoyed with perhaps the growth in the market. We decided to use that opportunity, if you like, to carry on with our plans, to carry on with those acquisitions. I won't lie and say that, we did renegotiate those deals because obviously the exiting owners suddenly had a much bigger risk on their part if those deals didn't go through, and negotiations were discussed accordingly. But all 3 of those purchases went through, and we're delighted that that we believe for both the sellers who in each cases have actually retired from the industry and are enjoying those retirements, and ourselves, we believe that we've bought businesses at great value in the medium and long term.
Ross, let's come to you as head of debt advisory. You work with a lot of businesses. Can you give us a bit of a snapshot of how this year has left companies more generally from your perspective at BDO?
Provide a little bit of context. Within debt advisory, then we advise businesses on raising debt capital right across the corporate life cycle. So whether that's positive, helping people raise debt for acquisitions, recaps, right through to the more challenging areas where we're amending facilities and or delivering sort of stressed refinancings. It gives us a really nice breadth as to what's happening in the market. Starting, I suppose, in March, I think we had 4 positive lender briefing documents ready to go to market for prospective borrowers looking to raise capital to fund corporate events. All of those were shelved on the basis that people didn't want to put leverage onto their balance sheets in a period of uncertainty. And then through the year, I suppose early summer, a lot of our time was spent engaging with clients of the firm and helping them, in effect, react to the situation. And it was very much short-term focused. A lot of it was around articulating government schemes and so on. But people were very focused on basically survival and considering how they manage liquidity. And then as the year developed through the summer, you could see that corporates' mindsets moved on, whereby they were more focused on medium term and thinking around resilience and how they adapted their businesses and how they adapted their funding to address future uncertainties. And then as the year went on through to late summer, early autumn, then we started seeing a lot more positive transactions occurring again. And again, people who then adapted their businesses to the new normal. To be clear, this is very sector specific, and it really depends on how agile and what sector those particular businesses are in. Clearly, at one end, you have the likes of high street retail, travel and leisure that continue to be focused on the short term and, to put it bluntly, survival. But at the other end, then, and a lot of our current WIP is actually focused on sectors such as technology, healthcare, pharma, and all of those businesses have traded relatively strongly, some not perfectly, but have demonstrated resilience through the crisis, and their mindset has moved forward into delivering positive transactions. But in terms of the lending market, it's really just accelerated a trend that's been going on ever since the credit crunch, whereby there are increasing options available to prospective borrowers. The old school thinking of relying on your relationship high street bank has really moved forward. And in a sense, the options available, things like ABL, from specialists such as Abn Amro, for example, or things like direct lending funds or credit platforms, the options available are much broader. And really then we're seeing that the high street banks are much more focused internally on their own challenges, which makes it, I guess the bar in a sense has been raised for new to bank lending for high street lenders.
That's very interesting, and it speaks to that acceleration, the way that the pandemic has accelerated a lot of trends we saw going on beforehand. Jeremy, let's bring you in. That's on that point that Ross was making there about the way in which sources of finance that companies are seeking have got more diverse. Tell us a little bit about what you've seen through the course of 2020, how you've been reacting to that demand, and a little bit perhaps about how ABN AMRO itself reacted to individual client requirements during what was obviously a very stressful period. It must have been stressful for you guys as well.
I joined ABN AMRO middle part of last year with a strategy and growth objective, and our budget this time was quite a bit higher than last year. And so coming into January, February, we built a really nice pipeline. So our clients can be mid-market to corporate and international size. When COVID struck and we were all suddenly in lockdown, which I think took us all by surprise of the speed of it, our business went to look. We had to put in place some strategies for existing clients. This time around, albeit this is, I think one of the words of 2020 will be unprecedented. Definitely, this is unprecedented. However, the regulations that came about from 2008, that financial crash, meant that banks were in a much better place and able to support existing clients, and from our perspective, also able to lend to new prospects. The M&A side of things just seemed to really slow up, with probably people looking at their own existing portfolios or existing businesses rather than looking at new acquisitions. Where people were willing to sell, of course, then there was maybe some form of price adjustment, whether or not that progressed, because I think people were definitely in that reactionary stage. I've got three buzzwords at the different stages. Reaction, because we didn't know what was going to happen. We really didn't know. And furlough scheme came in. A lot of people just put in hold position with government support there in the form of CBILS or other schemes. Obviously, it was quite an intense 10 weeks. It was quite challenging for a lot of people. We were clearly wanting to look after our staff as the priority, our clients, and we found that our infrastructure was resilient as we planned. We all skipped onto Teams or Zoom, as we know now. We took on new people because we committed to take on new employees. So it was quite different for everyone. But having said that, then we still progressed with the deals that did progress. As I said, a number just went in a holding position. Quite a lot of our mid-market transactions tend to be refinancings rather than M&A. And so they were from maybe a clearing bank where we offer much superior service than the clearing bank can offer, or a bit more flexibility or something, or other assets. So the opportunities for us. And those deals just literally went into a hold. And in fact, they've now come back, but there was a period of not a great deal happening in the mid-market. Corporate side, we completed deals. We've completed a number of transactions throughout the year.
That's been one of the stories of the pandemic worldwide, really, is that idea that blue chips have been accessing very cheap money. There's been a lot of government stimulus going into the economy. For people watching this who are from smaller businesses, what's been the alternative for them, if you like, and why, as Ross was saying, why have these alternative forms of lending accelerated in popularity? What's really driving that side?
I think, you know, there's been publicity about the main clearing banks just not having capacity, not having capacity or not able to open new bank accounts. And I think that's just pushed people to look outside. You know, even today, I was looking at an article with someone wanting a Bibbles loan, which we don't do, but because we don't do facilities of that size, but just unable to get it from their current bank. You know, I think the banks just had to suddenly adapt, and they just weren't able to. We're able to look at all the assets of a business, and then create some availability, not only against receivables. And I think the way that I've seen asset-based lending move over the last few years has been where we can look to other assets rather than just receivables. The transaction that we completed with Ross's team earlier this year was an absolute case in point. As a receivables deal, it had issues around it, but with adding in some plant and machinery, it was eminently doable. I think what's important is that ABL moves forward and says, well, we're not just invoice discounters anymore. Yes, we can do that, and that probably is still the majority of what we have in our book. But we can also look at other assets, which is important. Helps us remain competitive against alternative lenders, against other people coming into the market.
Yeah, Gareth, let me come back to you, because I know Recruitment Investments has a group of investors who are very supportive of your acquisitions and have been supportive of your general strategy. How important is that idea of flexibility? You talked about, you know, recruitment levels varying massively over the course of this year. We've got lots of uncertainties coming up in 2021, not least of which is probably Brexit. We'll come on to that in a bit, I'm sure. But do you recognise that story of more flexibility being a valuable asset for businesses like yourselves when it comes to finance?
Yeah, absolutely. It's absolutely crucial. You know, and again, I come back to ABN's support during this time, that they have been, you know, very flexible with not only on the lending side, but the insurance side as well, which we thought would be a real problem over the last 6 months. There's lots of business out there. You alluded to that, to the Brexit situation there. There is a lot of business out there in the markets that we are in. Most of our businesses are in the M1 corridor. We are surrounded by ever increasing sheds going up all over the place. There are hundreds of thousands of vacancies out there today, you know, for in the temporary labour market. But some of these players coming in, you know, especially foreign players coming in that e-commerce market, are new to the UK. We need that support from both on the finance side, the invoice discounting side, but also the insurance side. You know, so that we can actually manage that risk. And ABN have been incredibly supportive and flexible, you know, on that during this incredible period.
So, Ross, let me get you to talk a little bit then about the way in which businesses can best present themselves to attain that level of financial flexibility. We're still in very uncertain times. As we're speaking, vaccines are going into mass production, hopefully. We've had 3 vaccines confirmed. And the government's talking very positively about how 2021 is going to shape up. But I'm guessing there's still a way in which business should be approaching that appeal to finance providers, what's the advice that you would give them about how they should structure themselves or position themselves in order to get that kind of flexibility in their finances?
Look, undoubtedly, what we're seeing in the market right now is there is an increasing polarization in lender appetite. The job for a prospective borrower is to take the time to prepare and articulate the credit story and spell out the key risk mitigants to lenders. If you can make that job that much easier for a lender, who undoubtedly then needs to present this to their credit committees, your chances of getting the right type of finance are that much greater. The other element really is just there are so many more options available today than there were before. So if I think around comparing ourselves to where we were post the last credit crunch, the number of lenders, the number of options, the flexibility of the likes of ABL has moved on so materially. It actually taking the time to understand, well, what are the options available to me? And which of these options best suits what I'm trying to achieve? And then thereafter, it's actually being able to articulate the ask. So when you go to market, being able to spell out, here are my funding objectives. This is what I would like to deliver. You know, that the example that Jeremy alluded to there, that the deal that we delivered with ABN, in that particular instance, we had a business who had traded, had challenges trading, but they had a fantastic asset pool, albeit it was non-standard. The debtor book was contractual, and the P&M, there was existing HP. ABN delivered us a fully revolving facility, which provided real flexibility and without any material sort of financial covenant pressure, and at reasonable pricing. And that was quite differentiated from a number of the other lenders. But you need to be able to test that market, and you need to be able to ask the question, so you can work out what best suits your requirements.
Yeah. Jeremy, let's come back to you on that. Ross was talking there about creating options, and I know that you're very keen that your own clients take advice on this and have people like Ross at their side to help them explore the way the different options might work for them. But are you making judgments now about the way in which people are going to use the facilities that you're arranging for them? What's the sort of test that you're applying as we move out of the, I think you described it as the reaction phase and the kind of resistance phase, if you like, and into this new period where perhaps we're talking about covering the downside, but also making sure that we're available for the upside?
Yeah, no, it's a good point. You know, obviously, clearly, as part of our risk process, and part of what we even do before we go to credit in any form, we want to make sure that the business has got a plan in place. I remember one client we saw back in February, and when the hint, and we actually did we met them in person in March, just before lockdown, literally just before lockdown. And it was hinted, but it was no way guaranteed. But we kind of thought it might happen. And we asked them what their plans were, and they said, well, we've got extensive plans in for Brexit. We just see this as the next stage. And yes, it's different, but I think management teams really do go into a lot of thought. And obviously the larger businesses, this becomes a much more of a bigger process. That they go into significant discussion about what impacts might be to their supply chain, because really the pandemic was similar. What's the impact to my supply chain? How can I get the product out? They gave us an example. They had 9 sites. They were deemed to be key workers in their particular business, and they created the bubble effect, and they got very little cases. They were able to just keep going. I think again, people are more resilient now. They know how to monitor it. Hopefully, track and tracing is improving dramatically, so that we're able to track where the infections are more. So that will put business in a greater stead. So, but from our perspective, because we are an asset-based lender, which means we lend on the assets. What we clearly saw in April, May was that if a client had to shut down almost, or was on just ticking over, clearly their receivables had dropped off. Mm-hmm. So we needed to understand what their recovery plan was, how quickly, for us to get, to be able to be there and help them. Second lockdown, obviously different. Businesses have kept going, albeit not hospitality and etc. But yeah, we fund people who may be supplying to hospitality and retail, but we're not funding directly. So we can take that into account, and we're fully expecting basically business as usual from next week, in the work.
I mean, you made very clear there that you're talking about the assets that you're looking at in a business, and clearly that's always going to be the sort of acid test. Two other things crept into your response there, and I'm going to come to both Ross and Gareth to get their perspectives on this as well. But you talked a little bit there about the management team and their flexibility and adaptability, whether they had the sort of gumption to take this by the scruff of the neck. But also forecasting. And so I want to get you to muse very briefly on that. I would expect a private equity investor to be talking a lot about the management team. But to hear someone who's providing different forms of debt talking about it is very interesting at this particular moment.
Yeah, management, part of our analysis, in fact, it goes into our rating almost. Mm-hmm. So we're looking at a business and we're able to, yes, financials are important, of course they are, and the assets are important, but the management team, we love looking at management teams that have been doing what they've been doing for multitudes of years, mm-hmm. So they've got experience through troughs and peaks. I think that's really important. I think a brand new tech business coming to us is more of a challenge because we and rightly so. This is why it probably doesn't fit quite so well with asset-based lending. However, we have done them and they're in our sector. But it is a little bit more of a challenge because we're looking for track record. We're looking for experience. We're looking to understand where they sit with the particular business sits within their sector is always important. Who they supply to. We can be presented with a deal, and we can very quickly really get to the nub of what we see as principally the key issues are and whether we can overcome or not with our risk team.
Gareth, I'm not going to get you to muse on the qualities of yourself as a member of the management team, but perhaps you'd like to touch on that other aspect that I mentioned, which is the visibility, the forecasting that you can come up with. How has that changed over the course of this year for you? You were talking a few moments ago about the potential for an awful lot of activity to come to fruition as a result of changes to the economy, those big sheds going up for distribution centres, for example. But do you have much visibility? Can you make forecasts that will help people like Jeremy and Ross, obviously, to steer you in the right direction as far as options are concerned?
Well, it's very clear that regardless of exactly how the economy recovers next year, there is going to be, certainly in the temporary labour market, going to be an enormous labour shortage. There are 800,000 fewer foreign nationals living in the UK than there were 2 years ago. And as I say, there is absolutely no sign of a decline of these sheds going up all around us. E-commerce, and of course, as Ross alluded to, yes, the high street is unfortunately struggling in hospitality, but in terms of e-commerce, distribution, logistics, and what have you, that's really not the case. And there's still enormous infrastructure going up everywhere. 800,000 fewer foreign nationals that typically would have been formed a large part of that labour pool. I saw on the front page of the Sunday Times 2 days ago that there was just one case study of a daffodil farm
I saw that one
in Cornwall. They are 800 people short today, and that is the case all around us. In that I used the term with you before, Richard, about when we first chatted about us being a barometer, because we can in the temporary labour market we can just see things ahead of perhaps of the direction of travel. And it's very, very clear that today, that the actual shortage is not necessarily in the temporary labour market. Keep coming back to that point. Is not that there's a shortage of assignments and vacancies out there today. It's a shortage of people to fill them. So believe it or not, it's all about the candidate in 2021, about the attraction of the candidate and how we as a group can attract those candidates better than our competitors. It is not necessarily about panicking about, are you going to have temporary vacancies to fill? It's about who's going to fill them.
Yeah. So Ross, what Gareth seems to be describing there is there's still going to be a degree of uncertainty as we move into 2021 and beyond. But actually, we're not necessarily talking about a cave-in or a sort of permanent sort of disability within the economy. We're talking about something which we just don't know quite yet where we're going to see the pickup, where we're going to see sectors doing well and perhaps sectors still suffering a little bit as we adapt to this new normal. Do you recognise what Gareth's talking about there in terms of that lumpiness in our ability to forecast?
I think going into 2021, the main challenge is that you've got a lot of businesses that have significantly weaker balance sheets than they had previously. They've had to weather this crisis, and undoubtedly there will be casualties on the back of that. But putting that negative to one side, there is a lot more to be positive about now than there ever has been in terms of the vaccines around the relative certainty that they're providing. Previously, there's a lot of businesses that quite simply couldn't forecast to any degree of certainty. Whereas at least now, I think it's fair to say that there is light at the end of the tunnel. And with that ability to forecast, it gives people the ability to plan ahead and actually start thinking around their capital structure and start thinking around what their funding options are. And also, when you're able to approach a lender with a forecast that you can actually stand behind, all of a sudden you're that much more compelling and your options improve. So I think I agree that we still have uncertainty going forward, but relatively speaking, we're in a much better place than we were, say, in the summer. And the other thing I'd say is that during the summer, we went through a national lockdown and for a very long time. And in a sense, then it's given businesses an opportunity to demonstrate, now not all, but many, how they weathered that particular storm and how they recovered. So I appreciate now we're in another lockdown, second wave, and so on. But there's a lot more information to be able to share with prospective investors around how did we deal with the crisis to begin with? How do we demonstrate ourselves as being a very capable management team? How do we demonstrate actually what potentially was a low point in the business? And how do we demonstrate how we recovered through it? There's a lot more data and a lot more information to inform forecasts going forward.
And are you suggesting then that, it's too simplistic to say whatever doesn't kill you makes you stronger, but are you suggesting that we've actually started to build in structurally, whether that's financially in balance sheet terms or the way in which we employ people or the way in which we look for new business, a greater level of agility because we've had to in order to get through this particular period, and actually that might serve us well in the future? Is that the sort of positive message we can take out of this?
I think so. Look, again, this is specific to particular businesses, so those in particular sectors and those that have demonstrated agility or are able to demonstrate agility. That we can't blanket conclude that, but certainly for the businesses that have managed to demonstrate resilience through COVID, absolutely, they're in a position whereby there'd be a lot more robustness and understanding to their forecasts. The big challenge for me is that there's a lot of businesses with much weaker balance sheets than they had previously because they've inevitably TTP, paying rent, building up debt, and so on. There are those challenges that need to still be dealt with going into 2021.
Yeah. Jeremy, Ross is talking there about additional challenges going into next year. One of the big imponderables, and we're still getting different information coming out of the government seemingly each day, but the government support schemes are obviously going to end at some point. We've also got Brexit coming up. How are you guys looking at the way in which the reliability of that forecasting is going to work? What are the kind of conversations that you're having with people, and what are you looking for as people are talking about their activity levels and their desire to invest, whether it's plant and machinery or in resilience or in stock, for example, ahead of any potential Brexit disruptions?
Yes, yeah, that's a very, very good point. Clearly, in our mind at the moment, you see different things happening. You see an element of stockpiling, because that will be a feature at the end of the year. But I think the challenge we've got globally is that I myself, you look on to maybe buy a couple of things coming up, Black Friday coming up. And there is, the stock levels are definitely lower. Now, is that a consequence of people just buying more earlier? Not sure. Or is it could it be that there just isn't enough product being built and transported? One of the areas that we've seen a lot of activity is construction. We finance a lot of businesses in kind of rental equipment, putting out for construction. HS2 is now got the green light and it's proceeding. And what are we seeing? We talking to some of our construction type clients that they're having to keep equipment longer because they can't get new equipment. New equipment is on back order. And what you're seeing in terms of prices is different to what you'd expect. You'd have thought we're in a recession effectively, or maybe even worse. And therefore, prices should be depressed. But no, they're achieving higher prices. Now, we will quickly recover. And I think that's the critical point that businesses have got to get across in their projections, is that as to what both Gareth and Ross have already said, we know the impact, we know where the pinch points are, and we know how we adapted. But it's the companies that really have got a meaning to exist. There will undoubtedly be a lot of insolvencies. When we've seen it in retail, we've seen it in hospitality. Also, with the government support schemes, they, like you said, they're coming to an end. Furlough, we've already seen some uptick in a little bit of an uptick in unemployment. The civil scheme comes to an end, But then you've got other tax deferral schemes. What's going to happen there? Yes, that's government debt, but some of those are quite significant. And we have spoken to, one or two of our clients, and it is very significant. They would not be able to pay back in one go. It'll have to be some form of deferral scheme. And I think that you need to think about things like that. And we as a lender we need to look at those liabilities.
Yeah, Gareth, let's come back to you, because we're talking the title of this discussion is Flexible Finance for an Uncertain World. And listening to Jeremy describe it there, it does sound as if there is a difference between, and you started by talking about the difference between the strategic, staying the course strategically and having that flexibility operationally to adapt to circumstances. That seems like it's going to continue to be a factor well into 2021, where you need to be ready for an upturn, are ready for the brakes to come off potentially, to be able to deliver on that strategy, but also be ready for those temporary bumps in the road. Is that how you're looking at the year ahead?
Absolutely. Jeremy touched on 2 points there, very relevant to our planning. Number one is about that, deferred debt, as it were. And we've worked very hard in the second half of this year to make sure that anything that we did defer in the first half has been largely paid off. Because we don't want to go into the new year with that, hang over our head, and we've been able to do that as our business has grown in that second half there. But also in terms of that planning required for next year, I agree. I think there will clearly be, unfortunately, after Christmas, I think there will be another lockdown of some sort. I think that's the direction of travel, before mass vaccination can come in and everybody feels more comfortable about being circulating in a more, in inverted commas, normal way. Because that will coincide with our downtick anyway. And I think that for us next year personally, and the temporary labour market, there will be an enormous V shape, because it's typically in that way anyway. But next year, as normality returns, I think there will be that downtick in that first part of the year, even more so. But I think the uptick in that second half of next year will be hopefully extremely positive, and we all need to be ready for that.
Yeah, I mean, just as a quick aside, you're a business where seasonality is obviously a crucial factor in every year. Do you think that the fact that you have that seasonality makes it slightly easier to be resilient in the face of these ups and downs that you've been talking about?
The way it's worked is that, and again, as both Jeremy and Ross alluded to there, that just to give you a flavour, in the second lockdown, we have virtually no temporary staff furloughed. And that's because the work is there. Because as Jeremy and Ross alluded to, everybody has just needed to get on with it. You know, manufacturing, distribution, logistics, they've just needed to get on with it. So those vacancies are there, they're not furloughed. And in fact, you know, again, I come back to that point, there are more vacancies out there than people that are available today. Yes, that's part of the seasonality, that those vacancies are there anyway. And I think that will continue in an even more defined manner next year. The lockdowns have coincided, the worst lockdown, if you like, from a business perspective at the start of the year, coincides with our downtick anyway. And I think it will coincide with the normal seasonality downtick next year. But that just makes the uptick even more prominent. And normally what we see is that after Black Friday, which is this Friday, you tend to just start tailing off a bit. So everything from the temporary market really comes up to that point and then just tails off a little bit into Christmas. I don't see that happening this year.
Ross, you've been talking about the value of optimizing, should we say, your financial structures, looking at balance sheet, looking at creating options or understanding what your options are. Is that kind of new approach to the way in which we source financing going to persist, particularly as we see perhaps a different way of living and working evolve over the long term?
I guess in terms of the new normal and so on, raising debt capital, as I said before, it's sector dependent. Some businesses have been able to adapt to a new normal very, very quickly. And in a sense, actually, there's been a sort of flight to safety, as it were, of capital, whereby we're seeing debt terms, if not better than they were pre-COVID crisis in certain instances, because there hasn't been as many opportunities to put money to work, as it were. In terms of new normal for, let's say, the more standard business that has been impacted potentially by COVID, and then wants to understand, I suppose, what their options are and when would be the right time to raise finance and so on. I guess as every week passes, we learn more and more around the vaccines, when that will impact, and undoubtedly that is a key driver as to when normal will come back. But as we get more certainty, with more certainty around our forecasts, and there'll be more businesses looking to raise capital, I think change creates opportunities. And where you're able to access flexible capital, be that ABL, be that direct lending, be that credit platforms or so on, it should allow you to then leverage and take advantage of those opportunities. It again comes down to the mindset of the corporate, the sector, and that management team. There are opportunities there, and there are a greater breadth of options than there were coming out of the last recession in terms of funding options. So for those businesses that want to, they can absolutely utilize that and take advantage. But again, it is sector specific. Yeah. The only other thing I would say around, there have been positives that have come out of this crisis. Now, I appreciate it has been unprecedented, as Jeremy has said, to quote him again. We were actually told by our marketing teams that we weren't allowed to use that term anymore, as it's been overused. But nonetheless, people's ability to work and work in a much more flexible environment, there are positives. And I guess how people have adapted and businesses have adapted, you know, speaking personally, I get to see children a lot more, and I now have a puppy, which obviously fulfills a lot of stereotypes. But nonetheless, actually, it does, I think it inevitably is accelerated in creating more balance in the workplace. The other thing that's worth touching on is ESG. And I think lenders and investors are starting to put more credence on ESG and ESG investing, and actually having a broader positive impact on society. And we're actually seeing that come through now, whereby ESG policies are viewed positively by lenders to the extent that actually you can find cheaper finance, and there are incentives from lenders to adhere to positive ESG policies.
I know there have been a couple of very big corporate deals where that's certainly been the case just recently. Jeremy, I know ABN AMRO is very keen on its own sustainability agenda and loves to work with companies that work with sustainability as part of their agenda. Perhaps you could touch on that briefly, and then also give us an idea. You know, Ross has talked before about and you about the changes after the global financial crisis. It does feel like things like ESG, things like increased flexibility, asset-based lending in the most general sense of the term rather than unsecured lending are becoming much more embedded as a result of what's been going on in 2020 and in readiness for 2021 and beyond. Is that something that you would agree with, and just touch on that sustainability point as well, if you could?
It's very much in our minds all the time. We are a sustainability bank. Our goal is to help clients to become net zero. What's interesting is that when we go to see clients, we see that clients have got policies already. You know, this is not a brand new invention by any means. For some of our mid-market clients, one of the initiatives we're currently exploring is actually giving them us paying for a survey. Much the same as if you buy a house, you get an energy efficiency rating. But we're looking at the idea of thanking them for the business and saying, well, how about if we arrange at our cost a survey to just help you maybe validate what you're already doing, also, or maybe give you some other ideas. This is us really living by what we're saying, rather than just, we don't pay lip service to it. It's very important for us.
Yeah. So what about that secular shift to this more flexible form of financing then? Is that something which you're expecting? And from the discussion that we've had today, it certainly sounds like people need to be much more flexible, both in terms of the downside risk and also the potential upside, the opportunities that Ross was talking about. Yeah,
and I think we've proven that with the number of the measures that we've helped with our existing clients, and with new clients, you know, we have to take we've taken into account the flexibility. You know, generally speaking, when we put a limit together, we allow for growth or some change in the business. So, and that's where ABL, I think works really well. It has for many years, and the newer derivatives and newer financing that now can form part of an ABL package just go to reinforce that. It's a very flexible product. It just works for a lot of businesses, and I think it's untapped. I've always felt it's untapped potential. Because it comes down to not a lot of people know about it. I think in the past people would go to their bank and their bank would give them a product, but I think it's massively changed since then. And the advisors like Ross and his firm and other firms are very important to that equation now.
Yeah. So we're coming up on our time, really. I think we've exhausted people long enough, but I want to ask you all the same question to finish off, and I'll come to you first, Gareth. What's your one piece of advice to anyone watching this who is starting to think about how they plan ahead, not just for 2021 but beyond? To your point earlier, Gareth, about strategy and tactics and the difference between the two, but what piece of advice could you give people as they're looking to plan their finances for the year ahead? Gareth?
I think there's two quick things I'd say there. Firstly, as I alluded to right at the start, whatever your strategy was, whatever your, for want of a better term, dreams were, stay with those. As we've alluded to once or twice there, it's not like the banking crash in the sense that it's not a long-term economic shock. It's been a health crisis that's created a shock. But we then, hopefully we will then have a resolution to that, and we will come out the other side. And of course, as Ross has alluded to on a number of occasions, it is sector specific. So number one, stay strong on whatever your plan was. And number two is, again, look at those sectors, look at the sectors that aren't going to come out the other side. And obviously try, if your business can, to veer away from relying on those sectors. I mean, that sounds like a very obvious statement, but it is something that people need to look at. Is the high street going to recover? Is certain parts of hospitality going to recover? I don't know. I'm not really in those markets, so it's not a question I necessarily need to ask myself. But stay strong on your dreams, for want of a better term, and make sure you're in markets that are going to survive.
Be realistic. Yes, dream big, be realistic on the operational level. Yeah, excellent.
Hey, I could have said that in 4 words. I apologise, Eric.
And Ross, what's your tip for anyone watching in terms of injecting that flexibility?
I guess 3 things. Understand what the options are available to you, so as there is a much greater breadth of options that are there than there ever have been. Prepare. So before going to market, make sure that you've pulled together what is a convincing plan that can withstand challenge from lenders. People think that you go to a lender and they should lend you money. You need to make it compelling for lenders to lend you money, and you need to make it easy for them to sell that credit story to their credit committees. And the last thing is ask. There are so many options available, and there is capital that needs to be put to work. And if you're able to articulate your funding objectives, you should be able to find funding that aligns with what you want to achieve. But again, clearly the next one would be get an advisor, but that would be self-serving, so I shouldn't say that too much.
Thank you, Ross. And Jeremy, you're going to be hearing a lot of people come to you talking about their plans for next year and beyond. What's your advice to businesses coming to you and looking for ways to finance themselves flexibly in the year ahead?
Well, I'm gonna make a comment about the advisors, and that is do take advice. Do take advice. I think that's really important. We do get business. Some businesses have the time to actually spend and do it themselves, but others don't, and the majority don't, and because really they're doing their business rather than actually trying to find a financier, which can be quite complex. So take advice, and they know what's going on in the external market. Help you prepare the plan. Second point, well, yeah, it's actually maybe the final point should be, but we will get through this. Mm-hmm. And I think that's really important. And I think we are now seeing the end of the tunnel, which is great. Light at the end of the tunnel. The other thing, which probably should have been before that, is look at how your business has operated in these times, and take the benefits. Like we're doing that within our business because we're realizing that we can actually make decisions a bit quicker because we're all remote. We're not having to maybe have a committee meeting so much. So we're moving away from that. So in everyone's business, they will say, well, actually, we did manage to do that quicker than normal, didn't we? So take advantage. One thing we're doing for 2021 is recording and ensuring that we take advantage of all the things that we did differently and better in the midst of a pandemic. Every business can do that.
Fantastic. Well, Jeremy, Ross, Gareth, thank you so much for your thoughts. I think that's a very positive note to end this discussion on. But hopefully we'll come back to these themes again in the new year, and look out on the ABN AMRO website for coverage of this kind of discussion and other examples of flexible finance helping businesses through these unprecedented, to use that word again, and uncertain times. Thank you very much for joining us today.